evening, ladies and gentlemen. Welcome to Dream Series episode, and thank you all for taking out your precious time and being here today. We have our guest speaker, Mr. Rahul Singh, the CIO of Tata AMC, with us, and we are going to hear his views on equity market outlook. Mr. Sadeh Sinha, the founder and CEO of Dreamladder Capital, would be moderating the session for today. We'll be running a live Q&A at the end of the webinar, so if you have any questions, please start posting in the chat window. This you'll find on your screen, and if you miss anything, we'll be sending around the recording when it's available. Sadeh, over to you.
Yeah, thank you, Shubham. I would like to thank you all for taking out time on this Saturday morning to join the webinar. Today, we have one of the most respected names from the investment management industry, whose views are widely followed. On behalf of all of you, I would like to thank Mr. Rahul Singh, Chief Investment Officer, Tata Mutual Fund, for giving us the privilege to share his views on market outlook and interact directly with our clients. Mr. Rahul has around 25 years of experience in research and fund management. He joined Tata AMC in October 2018 as a CIO Equities, leading the fund management as well as the equity research teams. Previously, he was managing partner at Ampersand Capital Investment Advisors, and he has also worked with many reputed financial institutions like Standard Chartered Securities as well as Citi Global Market India as a head of equity research. Rahul is a BTech in mechanical engineering from IIT Bombay, and he's also an alumnus of IIT Lucknow. So welcome, Rahul, on our platform. So before you take the stage, I would like to set the ball rolling by asking you a very broader question. When we look back, we find year 2020 was a very eventful year. Even before pandemic hit us, our economy was facing few issues like a rising inflation, slowing growth, high fiscal deficit. Even there was apprehension of rebound in then prevailing low interest rates. Then came COVID, and we saw a precipitous fall in the month of March. So not only fall was surprise, even the V-shaped recovery, or you can say the elongated V-shaped recovery, was a pleasant surprise for several of us. So as we speak, we have recovered fully the fall since COVID pandemic hit us, but at current level of 14,350 odd levels, we are around 14-15% above the pre-COVID highs. So we have been the darling of FIs in recent months, and they have bought almost 17 billion in last 2 months. I'm sure you will touch upon these points when you will speak. But as an investor, we all are confused what to do now. So I'm sure most of us are waiting to hear your views on the market outlook going forward. And therefore, without taking much of your time, I would request you to give a general commentary, and then we will have a Q&A session at the end. Thank you, Rahul. Thank you, everyone, and over to you, Rahul.
Thank you, Sadeh. I hope I am clearly audible. Just as a matter of fact, just rechecking. Sadeh, I'm audible, right?
Okay. Yes.
Okay. So once again, good morning, and on behalf of Tata Mutual Fund, I thank you all for taking time out. Yes, it's very interesting times for us as a fund managers, and 2020 practically feels like we have seen 3 years in 1 year. Normally, these kind of cycles happen over 3 years, but we have seen it just happen over a period of 9 months. But let me just give you, a background of where we are in terms of the valuations, where we are in terms of fundamentals, and most importantly, I would like to start with where we are in the global context. Because what we have to understand is that today what is happening in Indian markets is, of course, a lot of it is to do with our own unlocking and the fact that COVID infection rate has not gone up and corporate profitability has looked up, which I'll touch upon later. But I think the first and foremost thing to understand for all of you is to look at it from a slightly broader angle of emerging markets versus US markets. US dollar behavior, what it can do to emerging markets in India, and then we will come to Indian fundamentals and sectors and what funds. So I will go in that order, starting from very top-down global factors and then coming down to more micro factors. So let's look at globally what's really happened and what's really likely to happen, or what are the chances of things turning around the way it has been in the last 7-8 years. So if you look at last 7-8 years, 10 years, just to go very, very macro, US markets have outperformed the emerging markets. US dollar has been on a strengthening spree. And that's because the emerging markets, the US market growth as well as low interest rates have led to a significant flow of capital, significant inflows into the US markets and developed markets. Also, the dollar strength has helped the emerging market, has not really helped the emerging markets. So while in the last decade, which is 2003 to 2008-9, we saw emerging markets doing very, very well and outperforming US markets. If some of you might recall, if you were in the markets or were had capital invested into equity markets, the last 10 years or at least 7-8 years have been the exact opposite of that. Now, is that changing? I mean, that's the first question to really tackle. I think the key here is that today we have a situation post COVID, and I think was an important turning point. Is that in post COVID scenario, what has happened is that we have seen the fiscal deficit of the developed markets, whether it is US, UK, and even some of the big emerging markets like Brazil, etc. The fiscal deficit has expanded, and the kind of impact of the uh, uh, the virus on the economies and the fiscal deficit and the debt situations of the developed markets has been much, much more than the emerging markets. Especially if you look at, let's say, if you with two very simplistic comparison of, say, Asia versus the rest of the world. While India had a high infection rate, it has recovered much faster. But rest of the Asia did not really face the same amount of lockdown or same amount of virus infection rate as the developed markets are facing, which includes Europe, UK, and US. So you have a situation where the deficits or so look at it in a simple way that if COVID has really impacted certain economies, clearly the impact on the developed economies has been more than the impact on the developing economies and emerging markets. So what has happened is that you have a situation where US, for example, just to take an example, is running a fiscal deficit of last year, I think in 2020, their fiscal deficit will end with some 17-18% number. This year, again, given that we have a Democrat government and there will be another fiscal stimulus, we are looking at another 10-12% fiscal deficit in the US. Compare that to India, where despite the strictest of the lockdown, and despite the fact that our tax revenues are not so great anyway, and we were not growing very well, I think the fiscal deficit should get arrested at 10-11%, is what the best guess is for fiscal year 21. So you can see that, and the recovery is very sharp. So fiscal year 22, you will be back to 4.5% fiscal deficit when the rest of the developed markets will still be running at 8, 9, 10% kind of fiscal deficit. So this is going to put pressure on dollar. This is going to put a lot of pressure on dollar, and the fact that if dollar starts to weaken even gradually year after year, then you will see emerging market flows coming back or sustaining. So what we are seeing in the last 3-4 months, when the FII flows have jumped up dramatically, not only in India but the rest of the emerging markets, is because of this phenomenon. And my sense is that some of this, it seems like it is going to be an affair which will continue, given that the infection rate is still pretty high. There will be stimulus in US, and therefore, as a market, while US had outperformed emerging markets last 7-8 years, we could be in for a period of, well, I don't want to call a very long term, but at least the chances of that reversing and the emerging markets doing better have increased dramatically. And that is why you are seeing the flows from FIs. One of the questions which I think you had raised. So how does India do in this scenario? Now, India will get its share of emerging market flows for two reasons. One, like I said, our debt to GDP after this year also is going to be around 80-85%. So we are not in the very, very high debt to GDP range. Yes, it's gone, but it's not in a very, very dangerous territory. Our current account deficit is still very, very manageable because of the low commodity and crude prices. So on a macro basis, while our GDP growth rate will only recover in FY22, and my sense is that the recovery can be more than 7-8%. So we are probably looking at a 10-11% kind of GDP growth rate in FY22, which is because of the low base. But that will lead to tax revenue buoyancy and fiscal deficit kind of becoming normalized, and therefore India should continue to attract its share of fund flows when they come to emerging markets. The only risk, the big risk for India, which I should highlight, is crude prices. If crude goes above 60 and stays there for whatever reason, for geopolitical reason, or because the demand recovers in China or the developed markets, then you can potentially see that the weakening dollar may not help Indian rupee or Indian flows as much as it will help the other emerging markets. So I think that's one kind of risk I would watch out for. The day you see crude prices going up beyond 60, the chances of that are looking little low, but you never know with crude prices. Then you will have a situation where flows into Indian markets will come down, even if the flows into emerging markets continue. So I wanted to set this global context in which we are operating, because it's very important to keep that in mind, since FII inflows are still a dominant force. Even when domestic inflows will come back into mutual funds, which I think they will, even if there is a minor correction. I think FII flows and the big global tide and the result of the weakening dollar is going to be a factor which is a much more important factor to kind of remember and keep in mind always when we look at valuations and look at how overheated the market might look. It may be a part of a bigger development which is happening globally. I think that is the context I wanted to give. Now, coming to Indian markets, I think for the first time in the last 4 or 5 years, what we are seeing is that the earnings are actually getting upgraded. So if you recall, last 5 years of, as far as I can remember, we've always started the year with an earnings estimate or earnings forecast of the top 200 companies or top 50 companies at say 15-20%. We always end the year with 0% or 5% or even negative number. This is the first time when we actually seeing earning upgrades in the second half. As far as our estimates are concerned, what we estimate is that the top 200 companies which are represented by BSE 200 had seen a 15% kind of earnings decline for FY22. When COVID happened, from March to June, you saw a decline of about 15% in earnings. 5 to 7% of that has already been recovered because of the recovery and because of the fact that companies, what you have to understand is, typically the question which I get all the time, and I'm sure that is crossing your minds also, is that there is a disconnect between economy and the markets. And I think there is a logical explanation for that. And the logic is that economy is today 65-70% informal. Of the remaining 30-35% formal sector, the top 200 companies is what matters from a market point of view or from an equity market point of view. And if you look at the BSE 200 companies, a lot of companies and all the companies have been able to protect their profitability even when the top line has not grown. So the disconnect between markets and the economy is always going to be there. You have to live with it because the markets are a function of the top 200, 500 companies which are in the organized sector, which are taking market share from unorganized. And more importantly, in COVID, they have been able to adjust much faster So starting with GST, demonetization, and then COVID, the larger companies or the better managed companies have become, stronger and stronger. And I think that is why you would see a disconnect between, say, how the top 200 companies are doing versus what you might be feeling elsewhere in the domestic economy. Now, can this sustain, and is this a healthy thing? No, it is obviously not a healthy thing, because if the unorganized sector continues to lose market share, and if the employment in the informal sector does not pick up, it will ultimately go and impact consumption. But that's a debate for a later stage. Today, the markets are going to look for signs of recovery in the top 200, 500 companies, and there the signs of recovery are very, very evident. Some of the expectation was that there is a lot of pent up demand which led to increase in demand by November, December. It is true in some sectors, but what we are also seeing is that there is a demand follow through even beyond the festival season. So we have seen, for example, car companies coming to us and telling us that it was not just pent up demand. So it's a mixed thing. I think there is a genuine demand recovery also. One cannot wish it away and say that it is only pent up demand. So what really today the markets are reflecting are, one, the global factor for re-rating the emerging markets, and secondly, the recovery in the domestic economy, and more importantly, more than the domestic economy, the recovery in the domestic earnings. So it started with IT and pharma sector, and it has now spread to other companies in manufacturing, consumption, and now it is also spreading to banking and financial services, where, if you recall, the fear was in April, May, June that there will be a lot of NPLs. Typically, I just give you a ballpark, whatever our fears were and whatever people were forecasting, I think the actual stress because of COVID in the banking system is half or less than half of what was feared. So that is also leading to an earnings upgrade. So initially there was a lot of downgrade, and now it is leading to an upgrade. But all this leaves us to a point of time where Nifty at 14,300 is trading at about 21 times 1 year forward earnings. So if you look at FY22 Nifty earnings, it is trading at 21 times of that, which is roughly about 12-15% premium to the 10-year average. I think that 12-15% premium can be justified because the risk-free rate and the 10-year bond yields have come down. But it has reached a stage where one can say that the markets are reaching fair value range. So if you are in a fund or you are invested into equities, does it make sense to de-risk a little bit? And I'll talk about how one can de-risk in your portfolios. Yes, I think that time is coming. Because at 21 times you are also factoring in the fact that the bond yields have come down. So most of the advantage or the benefit of low bond yields in the risk-free rate, and therefore the higher P ratio, is getting factored in also. But I think one of the big factors, in fact, if you look at beginning pre-COVID, is something which was my view, is again coming back to that point, is that if you get a economic recovery which is broad based, which is what is happening now, then I think the markets will become broader. So you may have a situation where index may not do much from here, which is Nifty, Sensex and all, but I think the broader markets will do better. Incrementally speaking, we are positive on pharma, banking, and infrastructure. Each one for its own reasons. I think banking, I mentioned about the recovery and the fact that a large part of the banking sector is still reasonably valued, not very expensive. And the recovery, if there is an economic recovery, the best sector to buy is obviously banking. Pharma, because of a different multi-year cycle, and also because post-COVID, obviously, sector has become more important from a export point of view, and India has become an important source for pharmaceutical, and the generic pricing pressure has also come down. Thirdly, on infrastructure and construction, I think that's the more controversial or a more difficult sector to call. My view is that we are coming to a point where, obviously, obviously the valuations there have not gone up. So that's the starting point. But I think we are seeing a beginning of revival in the private sector capex. Public sector capex, I think, will come back when the government actually announces the budget, because next year with the kind of let's say with the kind of cushion they have in terms of having not spent too much for COVID, I think that will come in useful. I don't expect a big pickup in public capex, but I think it will sustain. I think the risk was post-COVID that it may not sustain, but now with the pickup, I think it will sustain. But more importantly, I think the private capex side is looking up. We have seen some announcements, obviously coming from certain big sectors like cement, etc. But I think the big catch is there has been a move in the sentiment in terms of how corporates are looking at capacity additions. And we speak to a lot of corporates, and I think one of the big swings in mood we see is after the announcements of the production link incentive, the PLI scheme, which has been a good success so far. So you will recall that government started their Make in India program about 3-4 years back, but it never really took off. It just remained a slogan. It is only after COVID and that opportunity which is there for India to take market share or move capacities away from China. I think that opportunity government is finally realizing that that is the opportunity worth targeting. So really this whole Make in India slogan did not really result in any major investments coming into India. But what is really resulting major investments to come to India has been post-COVID, the whole sentiment change around China and government's quick reaction to that through the production link incentive scheme. So I think there is a small kind of green shoots in the private sector capex. And lastly, and not the least, in the individual side, we have seen last 7-8 years, not too much investments or not so much activity in the real estate market. But we are seeing that changing because, last 7-8 years, the real prices adjusted for inflation in real estate have not really gone up. In a lot of markets, it's actually gone down, adjusted for inflation. We have seen, developers giving discount, and more importantly, the interest rates below 7% are obviously helping the revival in the demand. So I think 2021, you will see real estate markets remaining reasonably buoyant, and real estate has a lot of ripple effect across the economy, not only to the banks and financial institutions where a lot of bad assets were stuck, but also it leads to a ripple effect of demand for building materials as well as home improvement, etc. So I think all the three sides of capex, which is private capex, public government capex, and individual investments, seem to be at a point where there is a potential for it to surprise. And therefore, when we look at infrastructure as a sector and look at the performance over the last 7-8 years, obviously it has been dismal, and everyone has. It is like everyone has not more than 4, 5, 7% of their portfolios invested in the infrastructure sector. So it's a bit like what pharma was 1 year back. And that's one sector where we see, and we are incrementally in all our funds allocating more capital. So that's really the the sectoral outlook. So to conclude, two things to remember. One, I think the markets at the index level, at these levels, there is they are near fair value. So I think the real returns will come from the broader markets, which is mid and small. And also on the sectoral front, I think the leaders of yesterday, which is consumer, will probably give way to more sectors like pharma has obviously done well, but I think banking and infrastructure should come back into that list of better performers for 2021. And as far as the kind of how you should be positioning yourself in such a market where, while the markets are looking fairly valued, there is a global tide of money coming into emerging markets. The risk for India, as I mentioned, is crude price. And while the markets are likely to broaden, the broad index is at a level where, at a various sector level, I think that the potential for significant returns from large caps have come down. So my view has been, from an allocation point of view, to de-risk a little bit. If you have a mutual fund, if you have schemes where you have large cap proportion as allocation, our recommendation has been to move from there to more categories like balanced advantage funds. And it's not something which you should do very often, but at some point of time, you should think about de-risking the portfolio and switching to balanced advantage funds. And balanced advantage funds as a category have done very well in 2020, including our balanced advantage fund. Our sense is that a balanced advantage fund category should be 30-40% of any average investor's portfolio, because we are allocating equity between 30% to 80% based on our model. And I think the entire industry has done a good job. Our model has done an extremely good job in 2020 of protecting capital when the correction was happening. So in March, our allocation to equity was 40%. It went up to 70-75% in May, and now we are down to 50% and coming down. So clearly, from a allocation point of view, I think it makes a lot of sense for making balanced advantage fund as a core part of your portfolio, and look at opportunities only outside of it in terms of any tactical adjustments which you might want to do. Of the remaining, I would recommend that multi-cap or a flexi-cap fund now. Most of the funds are converting to flexi-cap, and a mix of one or two sector funds or a small cap fund is how the allocation should be. So if you are an investor where 80, 90, 100% is into equities right now, pure equity, I would recommend 30-40% of that should be moved to balanced advantage funds or a hybrid fund. I think balanced advantage funds are preferable because they are at 40-50% equity allocation now. So if there is a correction, which are always difficult to predict, we can only speculate on the reasons for the correction, but we'll never be able to 100% accurately predict when and how much the correction might be. Then you will have protected capital, and if the correction happens, then the equity allocation in balanced advantage fund has the potential to go up from 40% or 30% to 60%, 70%, and then take advantage of the rise when it happens. So that is what I thought I'll give you a brief overview on, starting with global, then the domestic factors, and then necessarily the sectors and the funds, how I would want you to be looking at your portfolio. So that is all I wanted to give in my opening remarks. It's a very long kind of talk I gave, but I thought I'll let me cover everything in one go. And over to you, Sadeh, and if the viewers have any questions, I am ready to take them now.
Thank you, Rahul. In fact, it was very. In fact, you touched upon all the points. We can. Participants, you can unmute yourself and ask questions. Rahul, there is one question in the chat box. So in the sorry, I think I went on mute. So I'll repeat the question. Yeah. So Shubhadeep has asked one question. Does RBI move to normalize liquidity operations, which signal the beginning of the withdrawal of easy money, and are yields headed higher? So obviously, he's talking from the RBI, what they have announced yesterday evening. So can you touch upon?
Right. I'm not the debt expert, but I'll give it a shot. Yes, I think RBI has been doing two things. So on the long term yields, obviously they're managing it through the OMOs, and the short term through the liquidity. So this is clearly without raising the rates. This is probably the first step, and it's I think the markets realize that it is happening. I mean, from an equity market point of view, I don't see it as a big threat, because it's a signal to the equity markets that economy is looking up, and RBI's liquidity measures have actually helped the economy. So I think equity markets will take it in a very neutral way, or maybe even positive sense. But for the yields, yes, it could. I mean, again, as I said, I'm not an expert on the debt side. That is handled by my colleagues. But what you're saying, potentially, yes, the trend is likely to be that in the medium term yields or the short term yields. So let's see. As I said, it's not my domain expertise, so I would restrict my comments there.
Okay, fair enough. Participants, you can unmute and you can ask. In fact, moderator has allowed you to unmute yourself. You can ask questions. Yeah. So one question from Mr. Sehgal, who is from Middle East. So he's asking that what are your expectations from the Biden administration in terms of economic policies and trade stance vis-a-vis China? Again.
So I think the Biden administration cannot become pro-China. That's very clear. I think the sentiment in US is still pretty anti-China, and COVID has just worsened it further. So even though we don't have Trump, so we may not get the drama associated with anti-China stance in terms of tariffs and all. But I don't see any easing off with the compared to the anti-China sentiment, because I think any administration in US realizes that if they go back on that anti-China kind of feeling, they will lose the next elections again. So I don't think they have an option. I think they will remain pretty strong against China without too much headlines. So that's what I expect. As far as sorry, what was the other question before that on the economy?
Yeah.
I think Biden administration clearly, now they have control of the Senate also. They will try and push through more stimulus. We are already hearing about a 1 trillion stimulus, which is 5% of GDP. It's a fairly large number. So I would expect that they will like to push through more and more of their pet kind of schemes, which are mostly welfare schemes, and therefore it is going to be negative for the dollars. It is going to be negative for the government fiscal deficit, and also inflationary. I think if inflation rises in US and if the yields rise, then I think the US markets, it will again worsen the whole trade-off between US and emerging markets. So US markets are in a very complicated situation right now, because if they allow the yields to rise, it will hurt their markets. If they don't allow the yields to rise, then potentially dollar will devalue or weaken faster. In either of the scenarios, I think the Indian or the emerging markets should continue to do better than the US markets. And also remember that last 7-8 years, so much capital, so much money has flown into US equities, that even a fraction of that, if it starts to change direction to emerging markets, that's a lot of capital.
Yeah. There are a couple of questions. I'll take one by one. Shubham, can we allow participants to ask questions? Have you unmuted everyone?
Uh, 1 second, let me just check.
Rahul, you can unmute. In fact, you're muted.
Okay, sorry. Yeah.
Yeah, I think the participants can unmute themselves now for asking questions.
Okay, there are a couple of questions in the chat box. So, um,
Hello. Hello.
Yeah.
Yeah, one question. If we like now the recently Kotak Mutual Fund has comes up with global fund scheme. So do you
Mhm.
think that that scheme will be benefited in near future if they will invest in globally, and that scheme if we can invest some money out of some part from our portfolio, so it will be a benefit or what? Global
I
fund,
would.
I mean.
I cannot comment on Kotak Mutual Fund because first of all, I have not
I'm
seen.
not
I have
asking
not
Kotak
seen.
Mutual Fund, but like
No.
commonly I'm asking you.
Yeah, as I'm saying, if I think U.S. markets, if I'm saying that the performance of the emerging markets will be better than U.S. markets, so you need to find out where that global fund is going to be investing. If that global fund is going to be investing in US, then I would not be so optimistic about that fund doing well. It's better to invest in global funds which are probably investing into China or other emerging markets. So I don't know what that global fund is investing in, whether it's investing in US or emerging markets. That you need to find out.
okay. Rahul, I just want to rephrase what
Thank you.
so suppose as a strategy, if somebody wants to, construct a portfolio, so can you just, you just tell our clients that whether how one should have a kind of a small exposure of a overseas fund, maybe through some fund of funds or some other means. So whether that strategy is good for going forward to diversify the risk, because the different markets are not correlated, and from that perspective we are trying to just diversify. So maybe if you can
Yes.
on that point.
Yeah, so you should look for, and I don't remember any particular fund in India which is a fund of fund structure investing into emerging markets.
Mhm.
But that is one category you should look at, and it basically goes in with what I was saying earlier, that emerging markets should do better. So instead of buying a global fund or a US fund, which have become very fashionable
Mhm.
because the markets have done well, I think you should follow logically the fact that emerging markets are going to do better. So if you find a fund which is a good emerging market fund and not a global fund, then you should allocate something there.
Okay. So Rahul, one, I'll you. There are a couple of questions in the chat window, so I'll merge few questions and then I'll ask. The one person has asked on the inflation, right? So when should we start getting worried about inflation, given the fact that commodity prices or the oil prices have already started moving up? So you touched upon that kind of key risk for us, to look at the oil prices, and because obviously we import so much the oil, and our economy is so much dependent on that. So, but even for the in recent months, the commodity prices have started inching up, and that could be a risk for a, say, automobile industry. So if you can touch upon, and obviously that industry is facing a kind of a risk in terms of how the EV story is likely to pan out. So can you just throw some light on the auto industry, how one should play out that industry sector?
Yeah, inflation, yes, it's already going up, but I think the impact of that, as I said, one of the reasons why inflation is going up is also because of strong demand recovery in India and to some extent globally. So I think from an equity market point of view, a moderate inflation is somewhat positive because it's reflective of the pickup in the economy and generally the company's pricing power to keep increasing prices when the input costs go up. So yesterday only I was seeing that in India, For example, Mercedes has increased the car prices in January. Now, this is a luxury car you're talking about, and if they have the confidence to increase the car prices for a luxury car model, maybe for the entry car model, the price increases will not be so much, or the confidence will be a little lower. But it just tells you that the demand is right now not a constraint. Yes, at some point of time, inflation becomes so high that it starts to impact demand. I don't think we have reached that kind of inflation. If we remain in the 4 to 5% range, I think we are fine. And this I'm talking about excluding the food inflation. Food inflation is 7, 8, 9%. But if you look at today, the manufacturing inflation is about 5%. If you look at the core inflation numbers, it's about 5%. And I think 5% inflation is fine. If we start exceeding 6 and all, then the 10-year bond yields can also begin to move up, and that is when the equity markets will not take it nicely, and that is when the companies will also find it difficult to pass on the increase, because then demand will start breaking. So it's a very fine balance between having a demand recovery and allowing some kind of inflation to be there without having it completely gone up. So I would look for two signs. One, if the core inflation number crosses 6%, or if crude prices crosses $60. Both scenarios, I would think, would be the only time when it will start to become negative for the equity markets.
Okay, thank you. Rahul, I'll, on the telecom sector, what is your take on the telecom sector, as this is one of the sector where you see a lot of regulatory news flows. Every day you will find news in the newspaper. So apart from this one player which has raised so much capital that it can muzzle the competition, with its sheer deep pockets, or do you think that the price-led competition is history now, because we have seen consolidation in the sector, and we would see some kind of improvement in the ARPU for these telecom players? So how to play the telecom sector story?
Yeah, I think you're right. I think the second part is more right, because there are only 3 operators. Actually, I would say there are only 2.5 operators, because one operator has a very weak balance sheet and financial situation. And also the largest operator which has raised capital is also an incumbent. So remember that if he cuts the prices now, his revenues will hurt as much as the other two, because it's no longer a challenger, it's also an incumbent. So that switch has happened. And as soon as that switch happens, you will see that you normally see that there is price stability and there is rational behavior. So my sense is that you will see ARPUs going up. The dependability of people on data has only gone up post-COVID. So structurally, if any sector has benefited from a demand point of view from day one because of this, has been the telecom sector. So we are quite optimistic. We own, not that it's a very big sector with too many companies to invest in, but we own a fair bit of the companies which are listed directly or indirectly.
Okay. So again, I'll come back to the auto sector. It was more linked from the inflation and the price, the increase in the cost price. Although we have seen the auto sales number have been, strong in recent months, and that is more a kind of a sale from the, during festival season, we saw the good numbers. So, and also, after this, the current demand momentum is likely to continue, maybe because the mobility needs are going up, especially in urban areas, as the economy, has seen recovery from the lockdown. So do you think that trend reversal is away from the shared mobility and shift we can see towards entry level hatchback is going to stay, or this is just a kind of temporary in nature? And also, if you can throw some light on the rural versus urban play, or the two-wheeler and two-wheeler versus car, or a heavy vehicle, or tractors. So also the rural and urban components, if you can touch upon.
So I think the demand, whatever feedback we are getting from the entry-level car makers, is that it was not just a pent-up demand. It's a genuine demand which is there for the entry level cars. Two-wheelers, little bit of pent-up demand was there, and also in two-wheelers there will be going to be a disruption from electric vehicles much faster than it will be there for four-wheelers. So, but four-wheelers look more secure. So I would think that the demand is pretty strong, and I think it is going to continue for the four-wheelers, for entry-level four-wheelers.
Okay. And participants, I'm asking questions. You have an opportunity to ask a question from the person who is managing your money. So you can unmute, you can ask your question. Okay, on the financials, you spoke, Rahul, and in fact, I will just ask a different angle. In fact, many large private banks have reported lower moratorium, right? But the definition of moratorium itself varies across the bank. So, and this is very important from the overall, from the has almost 37-38% weightage in the index. So do you see that because of the recovery, the NPL cycle is likely to improve going forward, or we will see some kind of uptick once those moratorium is over for the banking stocks?
See, there are two things. One, because of the moratorium, they are not reporting the NPLs, but they are reporting other numbers, like you have how many slippages in 30 days, 60 days, what is the collection efficiency. So we have a fairly good idea of what the NPLs would be when the moratorium actually ends, and you will know that by end of this month, we will know also a trend in what would be the reported NPLs. But even if they don't report NPLs, as I said, they give a lot of data today in terms of collection efficiency, etc., which is giving us a fairly good idea of the stress in the system. And if you look at various kind of data points in terms of restructuring proposals, the SMA1, SMA2 kind of classifications, and if you let's say add SMA2 and restructuring, most of the large banks where we were expecting 7, 8, 10% to be the stress only because of COVID, the incremental stress only because of COVID is turning out to be only 3 to 4%. So it's less than half of what the market was anticipating. So my view is even if the reported NPLs go up, it is still far lower than what the banks and some of the NBFCs have already provided for by the September quarter. So what you're going to see, not only this, and I think the market also started building in provisioning or the credit cost for the next financial year also. So you will see a reversal in some of those provisions is what we are gathering, and that will lead to continue upgrades. So I would not worry about the reported NPLs because market is tracking the unreported NPLs much more closely, and there we get a lot of data points to really form good judgment of what is the real level of stress.
Okay. Kenneth, you have raised your hand. You can ask question.
Yeah, sure. Thank you, Sardar. Thank you, Rahul. I'm wondering, as an investor, should one prefer investing in a sectoral fund, specifically as you indicated, Rahul, for pharma, banking, and infra? So, as compared to investing in a balanced advantage fund, would you recommend someone to also take a look in sectoral fund, specifically related to pharma or banking?
Yeah, but not more than 10-15% of your portfolio. So I would not want you to buy a sectoral fund and make it 30% of your portfolio. As long as you keep it between 10 to 20%, I think that's ideal. And also in sectoral funds, what happens is that you also need to be a little bit more aware and change the sectors every 1 or 2 years, because it does change every 1 or 2 years. So what is looking good now may not look good after 18 months. And it could happen with a lot of sectors, or it could become fully priced and overheated. So in sector funds, you will have to constantly look at having the right entry and right exit strategy also. So it is therefore slightly more challenging and requires a little bit of more awareness about the real state of affairs before you kind of start. Which is why I said to start off should not be more than 10 to 20%.
Thanks, that's helpful.
Okay. On the IT sector, yesterday TCS. I'm not asking about the particular stock, Rahul, but TCS reported a strong performance at what little understanding I have. So even the revenue growth in US dollar terms was almost 5% sequentially, quarter on quarter, which was again there was a beat on the street. Even margin expansion was there was a kind of a beat on the street. So how you are reading in terms of the sectorals then that do you think that IT sector will report strong numbers in the coming quarters, indicating there is some kind of a strength in the demand environment? And at the same time also just want to understand or link it from the dollar index perspective, because if dollar is likely to become weak, so that can impact the IT sector, because the revenues are in terms of dollars. So how to play that sector?
Yeah, no, good question. Which is why I had not mentioned the IT sector and digital fund, which is our sector fund, which invests in IT services. I think fundamentals are looking good. Demand momentum is good. I think next 12 months the numbers will be good. A lot of it is though factored in, and in IT companies, these are big companies. All the Indian companies have become very big. So for them to increase their growth rate from 11 to 12%, so let's say the earlier projection was 10% and now they want to grow at 11%. That's a lot of effort. So they are, I won't say mature industry, but it's a stable industry. It will give you stable returns. It will not give you above market returns, is what my view is. And with the risk which you mentioned, which is the risk which is worrying me on this sector, is if dollar were to actually weaken sharply, or even if there is a 20-25% probability of that happening, at some point of time, one will need to become very careful about that risk. And today, the valuations are not cheap anymore. And so, while we still like the sector, it is not a sector where we are overweight on. It is an equal weight kind of a sector or slightly underweight. And if the sector moves up sharply and the risk of dollar devaluation is always going to be there this year, all the time, we would advise that one should be a little bit more cautious. It's not a sector, fundamentals are going to change, but the profit estimates, which are right now going up, are going to be under pressure.
Okay, so I'll continue to ask questions. Your thought on reality sector, Rahul, because this sector has seen interest in last 3-4 months. In fact, so, and this is encouraging as so many people are dependent on this sector. But on the other hand, and there are several sectors have very high linkages with sectors. So, what is your take on the reality sector going forward?
So, last 3-4 years, we have seen only the re-rate of the commercial real estate because of the global yields coming down and global money chasing the commercial yields. Now we are seeing that the focus is shifting to residential demand, and residential demand, as I mentioned earlier also. So I don't want to repeat all of it, but essentially because of a lot of factors around real estate prices not going up, bonds being there, developers giving discounts, governments giving discount, and also now the interest rates being lower than 7%, which has not happened in the last 20 years. In fact, KK Mistry of HDFC mentioned that in his entire working life, HDFC has never seen these kind of interest rates. So those are the things which are resulting in real estate demand, and I think I see that the residential demand for real estate will sustain this year.
Okay. I'm waiting. If yes, Morgan, you want to ask a question? Rahul, we had a lot of ongoing debate between growth and value stocks. Uh, last 2 years has seen a handful of stocks driving the whole market, right? So, and obviously, the big players are becoming bigger, and that we have seen across the sector. So the valuation, there is a talk that the valuation gap between the value and growth stocks are close to all-time high. So do you think that what is your take on this, or kind of those stocks are more a kind of a value trap? So please some light on this, growth versus value debate.
No, I think like I mentioned, instead of looking at growth versus value, I would prefer to look at different sectors, and some of the sectors which I mentioned, whether it's banking or infrastructure or even power, utilities, etc. They would traditionally be the value stocks. So you can make out from the some of the sectors which I mentioned that there the potential is looking better, somehow fall in the value category. So by that definition, yes, you can argue that value, which has not done well over the last 7, 8, 10 years, has the potential to do better. Also, when inflation goes up globally and rates start to not go down but slightly stable or going up, then that is when value starts to do. So I think I would tend to agree, but I don't want to make it so simple that it is just a function of value versus growth, because value has value traps also, and growth has some great companies which can continue to keep growing and surprising. So we don't really differentiate and make our styles according to value or growth. But yes, sectors, definitely one should look at sectors like I mentioned, and somehow most of those sectors which I mentioned have value stocks in it. So I think by that definition, yes, value should do better.
Yeah, I think Mr. Braj Kishore has a question. Sir, please go ahead.
Thanks, Uday. I joined a bit late, so pardon me if this question has been answered before. Two things. First is, where do we see the market going from here? And second, which are the sectors, focus sectors going from here?
Yeah, I covered that in great detail, so almost half an hour. So maybe if I request you to, if you can just listen to the
Sure,
recording.
sure.
But just to summarize, markets index, I don't expect too much of potential return from here, but I think markets will give better returns in mid and small cap. From a sector point of view, it will be pharma, banking, and infrastructure.
Thank you.
Last question from my side. In fact, before we close the call, Rahul, unless we have some other question for the participants, the ESG theme has seen popular, like getting popularity in recent days, right? And I was also looking at the data. The ESG funds have outperformed since last 8-10 years. But my question is, there is a kind of additional conditionality or criteria that stops you from investing a particular stock. So when you have a more freedom, why the ESG theme or ESG stocks will outperform? Suppose you have an option of not investing in ITC, and in ESG theme, obviously you are restricted. So you can choose not to buy a ITC. So just I don't know. Maybe if you can throw some light, this is taking like a gaining popularity in even in India. This is very popular in European countries. So how you think that this theme can play out, and why there is a disconnect between the performance and the kind of the freedom fund manager has in terms of the stocks where you can invest?
No, I think some of the performance, I haven't seen data on India, but globally you might be right that ESG funds have done better. And also because ESG rules out certain sectors like coal, oil, fossil fuels, which have not done well, all said and done last 8-10 years. Some of them have not done well for fundamental reasons and not so much because of ESG reasons. So some of the ESG factors like avoiding fossil fuels or avoiding tobacco or liquor are linked. So the underperformance of those sectors is not so much only because of the fact that just because there is an ESG fund theme, but fundamentals have also not been right for those sectors, which includes tobacco and other sectors like you mentioned. Incidentally, since you mentioned ITC has got a very high ESG score. I don't know whether you're aware of that. So they do a lot of things on the social side, which gives them a very high ESG score. But because their core business is under cloud, fundamentally, and tobacco usage is coming down, it's the stock has not done well. So therefore, it's not simple to ascribe all the outperformance of ESG funds just to the theme, just because there is an ESG theme. There has been fundamental reasons also for that to happen, and maybe that can change if tomorrow coal prices go up and commodity prices go up. You could see that the ESG funds may not do as well as a normal fund. So in India, it's still a new trend. We also look at ESG when we look at investments in our current funds. We don't have an ESG fund, so I don't really want to comment on how the other ESG funds are managing. I think you have a logic in asking that question, and I think in the global context, ESG has worked more because of fundamentals not supporting the non-ESG stocks, and not the other way around.
Okay, I don't see any questions. So Rahul, thank you so much for giving us the privilege to share.
Hello. Sorry to disturb. One question I have in mind, sir, if you allow me to ask.
Yeah, please go ahead. Yeah.
Yeah, only just one question, that how the impact of the specialty chemical sector, will it be good in your future?
In near future, I don't want to comment, but yes, it's a sector which has done well. Apart from the other sectors where India is exporting, chemicals is one sector which is going to be in focus, and it's going to be a big exporter. So we have today in India a lot of companies which are market leaders in their respective categories. Even though they might be small in the Indian context, they are still market leaders in the global context. There are a lot of examples like that. So we are quite positive, in fact, in specialty chemicals and which includes pharma as well as agrochemicals. We have in all our funds significant positions in some of these companies. So we remain optimistic. Valuations have actually gone up quite a lot. So maybe near future, I can't comment because near future they may not give you too much returns. But from a 3 to 5 year perspective, it's a good sector.
Okay, thank you very much. Thank you very much.
Okay, Rahul. So thank you so much for giving us opportunity to share your views on the market and interacting directly with our esteemed clients. So again, I want to thank you, and I want to thank all the participants to take out some time on the Saturday Saturday morning. So thank you so much, and now we can close the call.
Thank you, Zadeh, and thank you everyone, and Happy New Year again. Thank you.
Thank you, same to you.